So with the stock market being shut for a longer period of time over the last few days, today I thought let's have a little bit of fun. And today I'm going to talk about the 5 stocks in my portfolio that could 5x. So these are the stocks with the biggest potential to give the biggest returns in the future. Now, obviously, that's not me saying they are going to 5x, but if I had to guess which had the most potential and which were the most likely to 5x, these are going to be them. And today I'll kind of give you a bit of a backstory about the business, and then I'll also show you some numbers, what they would have to do to get to that 5x return. Now, obviously, I invest for 100% return. So if they were to achieve a 5x return, I would be really happy with that. But I am mostly investing these for double up. But if they were to 5x, that would be absolutely amazing. But to do that, they would have to execute to perfection. So today, the numbers that I will be showing you will be the execution to perfection with revenue growth, with profit margins, with metric expansion. So just bear that in mind. But I do think that there is potential that some of these can do it. So hope you enjoy it, and let's get started. Now, just a quick shout out, if you do get bored over the weekend with the stock market being shut for quite a few days, on the Patreon, me and Matty just did an hour and a half talking about stocks with many subjects in there, as you can see from this list here. So if you're on the Patreon, go watch that hour and a half video. If you do want to see the exclusive content on the Patreon, a link's in the description. £6 a month, unless you sign up annually, then you can get a year's subscription for £60. And as well as that, if you do want to start investing, use the link in the description for a trading 212 account. That's personally the investing platform that I use. If you use that link in the description, you can get a free fractional share worth up to £100. So let's start with number 1. It had to be on the list. Hims and Hers, my largest position in the stock market portfolio. And to be fair, this is actually a stock on this list that I have had a 5x return on. In fact, Hims and Hers at one point did come a 10x return for me, a 10 bagger when the stock did peak during this time frame. Since then, the stock has dropped 54%, and I actually think this has caused the stock now to go undervalued, and I am actively buying Hims and Hers again. And I do believe from these levels, Hims and Hers will come a 5 bagger. I will show you the numbers that they need to do to come a 5 bagger, and I'll also say why I believe the stock is currently down so much. So first of all, let's just go on a bit of a backtrack onto why Hims and Hers is a good investment. So Hims and Hers is a telehealth service, and they are entering a lot of categories. They have entered the SH category, dermatology, mental health, and weight loss category recently. Some of these markets are major markets, and they still have plenty of major markets to continue to move in. So even though they are a growing business, they have only just scratched the surface in the healthcare industry. Now, what they are able to do is they are able to do high quality personalized treatment. So they go direct to the consumer, and they're able to make a healthcare plan that is personalized to their medical needs. And they can get this all under their Hims and Hers telehealth platform. This is able to offer them big offerings in savings and also customer convenience for getting some of these healthcare products that they will potentially need. Now, they are also expanding massively into the weight loss category. This has been a major success for them. They were recently attempting to do the shortage of semaglutide, GLP-1s. This has recently been stopped though, because they are now no longer in a shortage, but they are currently doing personal dosage of the semaglutide. So for example, if you need a personalized solution because you're getting something like a lot of headaches, a lot of symptoms that are affecting your health, they can change this personalized dosage for you, and Hims and Hers are able to offer that at cheaper rates. They are also doing a offering of liraglutide, and they're also doing a oral based solution, which is like a tablet as well, which has had major success for them. Because they've had so much success from these personalized offerings, we have seen 45% subscriber growth, 69% revenue growth, and if you look at adjusted EBITDA margins, they have just expanded 6%, doubled up in 1 year as well. So this company is majorly ramping up the profitability. Long term, they are expecting this adjusted EBITDA margin to once again increase to 20 to 30%, with gross margins in the 70% range, which means that this company will have major profit in the future. So considering this company has financially been crushing it so much, why is the stock down so much? Well, a lot of that goes on the shortage of the GLP-1. So if we just go back to a slide I just showed you there, they were selling this semaglutide, which they are no longer allowed to sell because the shortage has been taken off it. Now, what they're going to do to get around it is they are going to sell personalized dosages of semaglutide. So they could say, hey, you know, you were having that product before, were you having any side effects? We can do a personalized solution for you, and by the way, it'll also be cheaper. That should do very well for them, and also the two other weight loss offerings that they currently do have as well. And even if something was to happen to the weight loss segment, like they couldn't sell the personalized solutions, people do not realize that even without the GLP-1 situation, revenue was still up 43%. So this company, even without the GLP-1 sales, is still growing insane amounts. And when we look at the financial point of view, you look at the revenue growth, you'll be able to see that where revenue has gone from 272 to 527, 872 up to 1.4 billion, and in this year 2.3 billion expected. That does put it down to a P ratio of 44 times on 2025 numbers and 30 times on 2026 numbers. If we do look at the financial health of the business as well, it's such a healthy company. There's no debt on the balance sheet. They do sit on 300 million of cash, and every year now they are profitable and they are going to generate nice healthy amounts of cash, which then could be leading to acquisitions to expand their services, or they could even do share buybacks. They are a founder-led company with Andrew Dunham running the business, and as well as that, he does own a 8.4% stake in the business, which is great to see your co-founder leading the business and also having such a good ownership inside the business. Now, if we were to look at some numbers, what would Hims and Hers have to do to become a five-bagger? Well, I've put 20, 25, 30% revenue growth in here. That is way below what they are currently doing. If you just remember, it was in the 40% range with even out the GLP-1 business here. So I am assuming some major slowdown in these numbers as well. Profit margin of 10, 15, 20%. As we've seen, they are currently projecting good profit margin expansion going forward. So I do see that being achievable. And I have put a 40 times earnings multiple in, which if we look right now, they currently trade at 51 times earnings. So I'm even factoring in some multiple expansion here when I'm looking at this as well. And looking at that here, on the low side, you're getting the 163% upside. And on the high side, you're getting the 623% upside, which is absolutely mega. And this is my number one pick for who is most likely to do it on this list, because even on these numbers here, I think the revenue growth is very conservative. I also think that this profit margin could be conservative, and I think that this company trades at more than 40 times earnings doing these numbers. So yeah, this is definitely the one that I feel would be most likely to do a 5x return. So I'm a big fan of Hims and Hers. Let's move to number two. So number two is actually my second current largest position in my stock market portfolio, which is DraftKings. So this is at the moment having a significant pullback at the moment, which probably shouldn't be happening for DraftKings. I was recently selling this out for a 100% return, and now I'm adding back in very quickly. So when I look at TAMs, I look at TAMs of what markets are going to grow massively in the next 5 years. In my opinion, this is one of the most fastest growing TAMs in the next 5 years, and one that I have the most clear sight on is going to be very successful. So what DraftKings do is they do iGaming, so like the slot machines on websites, and they also do sports betting like William Hill in the UK if you're wanting to place a bet. Now, in the US, this is absolutely bonkers to us in the UK, but in the US, sports betting was only allowed in 2018. Before that, you were not able to bet online in the US. That has led to a surge of growth in the US in the last few years, and going forward, there's still plenty of states that are there to allow online iGaming and online sports betting going forward. If you look at the latest numbers, we can see here that sports betting GGR was up 23%. If we look at the iGaming GGR, that's up 27%. And that's also very impressive considering we've not had any state launches recently for iGaming as well. Now, the most mature market, which is New Jersey, this was the first ever state that allowed iGaming and sports betting. If you look at the iGaming and sports betting growth from New Jersey, it has been absolutely exceptional, and this is quite a mature market for them. Even from 2022 to 2023, this was still growing 25%, even though this market has been online for many years. So even when they launch into some of these markets, they continue to grow very fast. And as that state matures, all it leads to is they don't have to do as much promotion to get the customers because the customers are already on the platform. That leads to improved gross margins, and you can see here as they go on, the gross margins improve as the state matures, and also the profitability as well. And that leads to payback as well being even in a shorter period of time because states are aware that they are getting launched into because of all the advertising that they're seeing. So now it only takes about 2.3 years for a state to come profitable. So as we see these states carry on growing, this is going to lead to more revenue, more states coming online, more profit as well. And you can see here the growth of the revenue and all the profitability metrics moving in the right direction. By 2028, we're expecting 7.1 billion in revenue with adjusted EBITDA margins of over 30%. That's higher than what we just actually showed on Hims and Hers. And if you look at the current states that are currently out there, there's so many sports betting states to still come online, but as well as that, iGaming, and iGaming is only currently in 5 states, and that is the potential for even more profit and even more revenue growth going forward. So just as sports betting stat is going to start maturing in the next 5 years, then you also have the boom of iGaming to come. This has many drivers for the next 10 years. And as well as that, DraftKings also have a very good duopoly in this space at the moment. Looking at this company, I put 20, 25, 30% revenue growth in. As we can see here, New Jersey is still growing at 23%, even though that's a bit of a mature state. So as these states go online, I see no problem with DraftKings getting 20 to 25, 30% revenue growth. I would even argue that is a little bit conservative. Now, obviously, we can see they're aiming for 30% adjusted EBITDA margins. So a 13% profit margin seems very easy for them to achieve. 40 times earnings for a company doing these growths, I would even argue the case that this is a very conservative metric expansion. And on the high side here, we are getting that 5x return. Well, 494% return, but as you can tell, I still think that revenue growth, profit margin, and the multiple expansion is still a pretty cheap valuation for that one. So yeah, I do think DraftKings is a very interesting stock to be owning right now. Number 3, SoFi. So there is 2 finance companies on this list, and this is the first finance company on this list. Right now, having a very significant dip as well, currently down around about 40%, well, 38%, and that is a very tempting dip in my opinion. Now, looking at SoFi, so originally SoFi was started as a student loan business, so it was the refinancing of private student loans, and Anthony Noto has come into this business and he has set the company up from just being a student finance loan business to a provider of all in one place on SoFi. So previously you'd have to get to loads of different places to get all these products, but what Anthony Noto has done is he has put this all in one platform, and he is what I would say is the Jamie Dimon, the young Jamie Dimon coming up of the financial space, and he will be the next big thing in the finance space going forward with this business. You can see when he came in at 2018 and all the other products that have been launched since then, like the likes of the Galileo technology platform, which I won't even mention today. We also look at some of the other platforms like the loan business that's been coming in at the moment. And that's led to so much good financials, with revenue growth up 26% here, as you can see, just off the back of their first full year of profitability as well, and all the metrics moving up in the right direction. And now they've got the one-stop shop where everybody can get all of their financial needs in one platform on an online business. Now, because SoFi is more at the moment for the younger users at the moment, as these younger users scale up from just using their student loans, they're then going to access things like their home loans, personal loans as they get older. So the customer base with SoFi as they mature is only going to lead them to spending more on the SoFi platform, and then they make more profitability from them. You can see members are growing at a CAGR of 53% and new products up 55% as well. With SoFi, I put 15, 18, 20%, 21% revenue growth in, and they have been doing this growth in a time frame which has been a very hard environment for them to get that growth. You know, interest rates have been incredibly high at the moment. Student loans have been paused for a good amount of time. If they start coming back, you also have the likes of the lower interest rates, for example. People are more willing to take personal loans out. People are more willing to go buy houses. You could actually see this growth rate accelerating in the future. Profit margins of 20, 24, 28%, and a 40 times earnings multiple we end up having SoFi with 534% on the upside, and I do think there's a chance that SoFi do hit those numbers. Moving on to number 4, which is a energy company, a solar energy company, which is Enphase. This is the one that has been hit the most on this list. From its highs in 2022, the stock is down 84%. So this has had a very tough time. Obviously, some of these stocks on this list have had a bit of a drop, but this has definitely had the most significant drop out there. So first of all, let's talk about the drop. Obviously, 84% is a significant amount. Why is the stock down? Well, what happened is back when the stock peaked, oil prices were sky high. You can see here on the chart how high oil prices were. Since that time, oil prices have halved. Now, because oil prices have halved, what happens is, because they are solar energy, people go get solar energy quite often when oil is expensive, because people notice it and they go, I'm not having this anymore, I'm going to go get solar energy. When the oil prices come down, people are like, I don't actually mind paying these prices at the moment. So one thing that will happen, I think oil prices will start increasing as we do go forward, and that will hopefully put more people into buying solar energy. The other thing is interest rates. So interest rates, as you can see here, went sky high. They went from 0.25% in 2022 all the way up to 5.5%. Now, at the moment, interest rates still remain pretty high. We've only had 1, 2, 3 cuts there, and we're still at 4.5%, so way higher than where we were in 2022. Now, when you are selling solar energy, people do not buy big, expensive solar energy installs into the houses when interest rates are high, because they cost a lot to install. A lot of people get it on finance. People aren't going to do that. But as these interest rates start coming lower, I think that people will be more open to getting the solar energy because it will be cheaper on the financing point of view. And that should happen. When we look at inflation, inflation is sitting around about 2.4%. Even if we take the latest data, it's 2.7% as the forecast is at the moment. At the moment, for interest rates to be nearly double what inflation is absolutely insane. So I am thinking more cuts should come. As we know, the Fed are always historically very slow to react, very slow to put up interest rates up, and they're also very slow to bring them down. So hopefully that corrects itself soon. So if oil prices start put a bottom in and start going up, and interest rates start coming down, I do believe that the solar space will start picking up. The TAM, there's loads of different numbers out on how fast solar energy is going to grow, but I would say in the next 5 years, people are going to be buying more solar energy or using solar energy more in the future, because it is going to be more green, people are getting more conscious, and it is cheaper as well. So I think solar energy will grow. There's different figures on how fast this space is going to grow. For example, we've got 12.7% here at the moment between 2025 and 2033. At the moment, Enphase is the best in the business. They are a patented product that do these microinverters. So they go under the solar panel individually, and very different from what traditionally happened with solar panels, which were string inverters. What would happen is you would only have one of these microinverters basically, and it would manage all of the solar panels. If one solar panel had broke, didn't see the sun, for some reason it had dirt on it, you would only get energy from your lowest performing solar panel. Enphase came along, they made these microinverters, and they go individually on these panels. That's why it costs a little bit more than the traditional product. But what would happen is if you had a panel that didn't work, it didn't matter, because Enphase, with their microinverters, it would still get all of the energy from the other performing solar panels out there. As well as that, they have the microinverters, but they have other platforms as well. So they have the EV chargers, they have the Enphase app, the cloud platform as well, so you can see how well it's performing. The battery as well, one of the best battery networks out there. And we are starting to see the bottom of the financials in. So you can see the slowdown in 2022, which was caused by the higher interest rates and oil prices coming down. As you can see here, we're about where the bottom should be in, and at the moment we are starting to see the financial recovery of Enphase. In the next quarter, which I think they're actually reporting on Tuesday, we are expecting 37% year-over-year growth, which is absolutely nuts, and EPS to go from 0.35 up to 0.72. So we'll see what happens there. They also have a pretty decent balance sheet as well, so they are able to do a good amount of share buybacks as well. So in the latest one, they did announce a $1 billion share buyback, which if you do look at the stock price, it's around about 6.8 billion. So yeah, over 10% of the market cap, as you can see here. So when we have a look at Enphase's numbers, we can see here I put 10, 15, 20% growth in, which is a lot slower than what they're currently going to do in the recent quarter as well. And profit margin of 15, 22 and 30%. 40 times earnings, and you can see here that on the top side 450%, well 456%. But like I said, they are doing aggressive share buybacks. So with the share buybacks in, I can just about see a 499% return. So let's call it a 5x there. Yeah, obviously that would be great if they are able to achieve it. And that leads us on to the last one, which is New Holdings, number 5. So the second fintech platform on this list here. This one's having a little bit of a drop at the moment, down around about 30%. The reason why is it does operate in Brazil, so you do have some kind of geopolitical risk there. You also have the potential of FX impacts going on there. But even with that factored in, we shouldn't see it that much where it's down 30%. And I would actually argue the case that the actual FX impacts could easily be tailwinds in this latest quarter, considering how much the dollar has weakened. So if anything, I would suggest New Holdings should probably be up during this time frame rather than down. Now, like I said, they are a fintech platform and they are in the areas of Brazil, Mexico and Colombia. So they did launch in Brazil originally, and then you can see Mexico was launched and Colombia was a launch. You can see here that the real big explosion did start in 2022. The reason why is because previously in the likes of Latin America, there wasn't much e-commerce, so people didn't really do online digital banking. And as well as that, the whole COVID thing kind of sped everyone up to use online digital payments as well. And since then, all the people in Latin America have gone, actually, this is amazing. And there's been a big explosion, as you can see here, in that usage. Financially, very good growth here. If you do look on an FX neutral basis, over 50% revenue growth. If you do look at the actual numbers, it is slightly lower than that because of the FX impact. Gross margins as well, scaling up, as you can see, and also net income. We are achieving in the latest quarter, the financial year, 28%. That's up from the current 18% as well going forward. And customers are still growing at 22% as well. That's leading to some very good growth in New Holdings as well. And that means it currently trades at around about a forward P of 19. If we do compare that to some other fast-growing Latin America companies, like one of my favorites out there, which is Mercado Libre, that's currently 55 times earnings, so big potential for metric expansion, as you can see there. Now, looking at revenue growth, I put 15, 20, 25% in. This is way below the FX neutral growth that they are currently having, which is, like we said, about 50%, so I'm assuming a bit of a slowdown once again there. 17, 19, 21% profit margins, and around about 40 times earnings, because a company going this fast should be a bit of a premium. And if we do look at Mercado Libre, for example, that trades around about 50 times earnings, still being pretty conservative on that point of view. And you can see here on the high side, we're getting around about 518% if they were to execute on these numbers and to trade at those sort of metrics. So yeah, New Holdings is definitely a very interesting one as well. So that is number 5. I hope you enjoyed the video. I wanted to do something a little bit different, something a bit fun over the weekend, so I hope you enjoyed it. If you could hit the like button, the last video didn't get many likes, so if you could, make sure you like it because it helps it get out there on the YouTube algorithm. And if you could, share it somewhere in an investing group that you're in as well. Tell me which one is your favorite. Tell me which stock you think could 5x in the next 5 years as well. Apart from that, have a great weekend and I'll see you on Monday.